Hello, my name's Craig Erlam, Senior Market Analyst at OANDA. Today we're going to talk about the S&P 500. It's been quite a difficult month really for US equity markets. Really, if we go back to the start of the fourth quarter last year, it really has been very volatile. And of course, most of this relates very much to the same stories. When we're talking trade talks between the US and China, these have started off very much on a difficult path. It looked as though towards the turn of the year we were starting to make some headway. The G20 summit in December seemed to be a turning point when the two leaders met, and that's also around the time that the market started to bottom out. It was in that fourth quarter of last year we saw a 20% decline in these equity markets, so there was clearly a lot of fear around that time. The other factor, of course, that led into that was negative yield curve. So this is where the shorter-term bonds were yielding a higher return than longer-term bonds. Now, that doesn't make any sense in normal markets because that suggests that people are demanding a higher premium to hold cash for 3, 6, 12 months rather than 10 years, which is the opposite really of how these things tend to work. And what we've seen is we've seen these stories very much redevelop again recently. Talks seem to be going well with the US, and then a few weeks ago it became very clear that they'd hit a significant stumbling block, almost entirely collapsing over the last few weeks. That's had a shock on the markets. What we've seen since the start of May is the S&P 500 has fallen around 5.5% to 6% so far, and is at risk of falling much further. At one stage, it looked as though we were holding around that kind of 2,800 level. We tested this on a couple of occasions, and this was holding steady in the near term. That suggested that markets felt they'd readjusted themselves for a difficult period of negotiations, but any fears beyond that were relatively contained for now. Now, what we've seen really over the last few weeks is fears of negative yield curves have materialized. And again, this is the reason why this is a significant fear. Like you may look at this yield curve and say, well, this isn't a big deal. All it means is that temporarily the curve has changed in such a way that people maybe anticipate a rate cut or two. That's no big deal. We still expect interest rates to rise in the longer term. But as you can see from the chart in front of you now, it potentially suggests there's something more significant going on. So this is from the Reuters Icon terminal. And what it shows is that 3 months, 6 months and 12 months are all offer higher annual returns than the 10-year. So this suggests that it's not just a short-term issue that we think is being anticipated from a market's perspective. It's potentially a deeper downturn unless something significantly changes either from a central bank perspective or from a global macroeconomic perspective. Now, there's two things that people seem to be looking at closely. One is the 2 to 10 year spread. Now, at the moment, that's not too bad. That's actually in positive territory. This has been seen as the recession indicator from a market's perspective over the last few downturns. The one that the Fed apparently pays more attention to is the 3 to 12 month spread. Now, this is at its lowest point now since the global financial crisis. The time before that, when we saw this dip into negative territory again, was back in 2000, the dot-com crash. So that's why people are again starting to fear this, and I think that's what's triggered this latest bout of weakness in the S&P 500. So what does that mean going forward? Well, for one, it means that there's still significant vulnerabilities in the markets, and these vulnerabilities are something that Donald Trump, we know, pays close attention to. There's two things he's paying close attention to. One is the stock market, and the other is his poll ratings. He seems pretty comfortable with his poll ratings at the moment, but markets is something that could really shake him and could force him to readjust. We saw after the spat with China increased that he started to talk down the spat, calling it a little issue effectively. We could see more of this in the coming weeks. We've seen him talk up the prospects of a trade deal with Japan in August, again trying to alleviate some of those fears. The final chart we have for you, though, is the Fed funds futures. This shows that markets are anticipating more action from the Fed, not steady monetary policy, but at least one rate cut, maybe 2 rate cuts this year. More than 80% chance of 1 rate cut, 50% chance currently of 2. And if the markets continue to move the way they're moving right now, I expect that to change and more rate cuts to be priced in. Perhaps an overreaction, but very much the way the markets are headed right now.